Hello there. We're getting started now. I hope everybody got the message in time. I'm going to cover a couple things tonight. First, I'm going to go over a couple real-life trading strategies that we developed at my company, Sortino Research. I thought you might be interested in them. And then we'll go over the assignment that's due Monday, and I'll take questions and answers. I'll take questions and give answers. Okay, I got one viewer. Great. All right, let me start with a, let's review the project a little bit while we wait for folks to show up. And then I'll start the presentation about real-world trading strategies. Okay, I'm going to share my browser. So this is the project that you all are working on. Let me make it a little bit bigger there. I'm going to turn on my question and answer screen so I can see any questions that you all might have. Is this thing on? Yes. Let me know if you don't hear me, but yeah, it's going. Okay, so for this for this project, you're to build a strategy based on Bollinger Bands, and you start by just building the straight strategy as it's described on the wiki, and then I want you to create your own strategy. You can riff on Bollinger Band if you like, or you can create something completely different. Let's talk for a moment about the time period. So we're working from, we're using IBM only, and you can begin to trade as early as December 31, 2007 and go all the way to December 31, 2009. Now, classic Bollinger Bands take about 20 time periods before they can start working, so you shouldn't see any trades until after the first 20 days. Okay, I'm seeing that that people can hear me. Good. Okay. Now let's define Bollinger Bands real quickly. So first thing you need to do is calculate a simple moving average. So you got your stock data going like this. Your moving average is kind of a smoothed version of that. And then above and below that simple moving average are the upper band and the lower band. The upper band is 2 standard deviations above the simple moving average. Lower band is 2 standard deviations below it. And the general idea is if the actual price punches through the top Bollinger Band and then comes back down, basically going to the top is confirmation that the price has diverged significantly from the moving average, and it's probably going to come back down, but we wait for it to punch back through the upper band before that we treat that as a signal. So it's gone out and it's coming back towards the moving average, and the idea is it's going to be headed down, so that's a short opportunity. If you were to enter that as a short opportunity, you wait until it passes the simple moving average to exit. Let me scroll down to an example here. So this is the kind of chart you are to create. This blue line here, see if I can scroll a little bit there. The blue line is the price as it's moving along. This yellow line is the simple moving average, and above and below that are the upper and lower bands. So here, right here where that first red line is, that indicates a shorting opportunity. So the price went above the upper band and then came back below it. And right there, that vertical red line shows a short entry. The price continues along. Here, it goes below the simple moving average, so that's an exit. So one of the things you're supposed to do as part of this project is to draw vertical lines, red line indicating short entries, black vertical lines indicating exits, and here's a green line indicating long entries. And again, so whether you enter long or short, the black line indicates the exit. So we have short opportunity, here now a long opportunity. As you can see, it went below the lower band and then went back up through it. So that's a long entry, and then we exit when it crosses the simple moving average. So that's the general idea of the strategy. Let me real quick peek and see if we have any questions about that so far. Okay, I see somebody says they missed 2 minutes and 30 seconds. Let me know if you need me to catch you up on anything. And I'm checking to see if there's any questions. No questions yet, so I'll continue on. Okay, so you should use the IBM data that's available to you in the data we've provided, and then you follow this strategy as it's described here. And the sort of first deliverable is to create this chart that I just showed you. So that chart should show the price, the simple moving average, the upper Bollinger Band, the lower Bollinger Band, and then vertical lines indicating entries and exits. Now, once you have written the code to create this chart, it's trivial to go from there to generating orders. So you should modify your code such that now, instead of drawing these vertical lines, you issue orders into an orders file. So whenever there's you start with $10,000 at the beginning of that time period. Whenever there's a long entry, buy 100 shares of IBM. You hold it. You only hold one position at a time. You hold it until the exit arrives, and then you sell the 100 shares. So at any one time, you're either long 100 shares or short 100 shares or just in cash. And again, when you enter a short position, you hold it until the exit. Then you exit. If you're short, you exit with a buy. If you're long, you exit with a sell. Now, one thing to observe here is the first. So even though we started looking at the data at the end of 2007, the first trade doesn't occur until I believe it's late April 2008. So when you look at your orders file, all this here will not be traded, and again, you have that first trade in April. So if you follow the instructions for your market simulator is only going to calculate statistics on your portfolio from this first trade until the last trade over here. And that's the data that I want you to use when you compute your statistics. So you generate this orders file, and then you can analyze you can generate this performance chart like you did for the market simulator. Here, green is SPY, which represents the S&P 500. Blue is the performance of the strategy. And as you can see, we've got a flat line here up until end of April. Then we're in IBM. We actually lose some money on that. Well, I'm sorry, we almost break even because it comes back up before we exit. But we lose a little bit. Anyways, trade. Gradually, we build value there. It turns out to be a decent strategy overall. And in the end, we get up to nearly a 40% return across these years. You should analyze the performance in the same way we've done before. One thing to point out is because the first trade doesn't happen until April. Okay, I don't know what happened there. Okay. Because the first trade doesn't happen until April, this date range that you find is going to be a little bit different. We have recalculated this data oh, I'm sorry, the first trade is in February, not April. I got my months screwed up here. So let's go back up and look at that. So here's the beginning of March 2008. Here's the first trade. So it's in February, end of February. Anyways, your dates here will be starting sometime February 2008 and going on until 2009. Here are the first few trades for your reference. Okay, that is what I'm calling the baseline strategy. Now I want to emphasize there's a difference between a baseline and a benchmark. So the benchmark is what we use to compare our strategy to. So for instance, if we're trading with S&P 500 stocks, the S&P 500 is a typical benchmark. If we were, actually one could argue that a really good benchmark for this strategy would be just IBM itself. But I already put in the project that it ought to be SPY, so we'll go with that. But anyways, this blue line here is our baseline, because later we're going to see if we can do better than that baseline. Okay, and then that's actually the core of this project is you need to create your own strategy. So it doesn't have to use Bollinger Bands. It can use some other approach. You can modify Bollinger Bands a bit if you like. Whatever it is, you need to explain it well. You need to explain it well enough that someone else could reproduce what you're doing just from reading your description of it. Then I want you to run that strategy across those same dates that you did the baseline. And we're going to call that in sample, in the sense that you're trying to tune your algorithm so it works really well over this time period. But then I want you to also test it out of sample. So from end of 2009 through to 2011. And I just want you to report the results of both. But what's important is your in-sample performance has to do better than the baseline. And below here in the rubric, we talk about the credit you get for doing better than the baseline. So if you do two or more times better than the baseline, you get the full 10 points, so you can get 100% there. If you don't do better than 20% better than the baseline, you get 0 points for that component, and you could get up to a 90%. So that is this upcoming assignment due Monday night. So let me check and see now if we got any questions. All right, we got a couple questions here. Could the Wiki daily portfolio value chart and statistics be updated? Maybe. You know, I think you all got to figure some of this stuff out yourself. You know, we're guiding you a lot as we move forward here. There's going to be a little bit less guidance. We're going to become a little bit more like a research class now. Okay, I don't see any other. Well, here's another question. Why are words hyperlinked on your web page? I don't know. My son has been using this computer, and it bothers me. He's not going to be using this computer anymore. Okay. Do we need to develop our own indicators for the second part? Yes, you need to develop your own indicators. Just checking for other questions. So the question is, when is it due? I thought it was due this upcoming Monday, but I'll double check there. Oh yeah, we have spring break coming up next week, so that's right. It's due a week from Monday. All right, just clicking through these other questions. Okay, that's it for talking about the project. I'll still come back and answer questions that we get there. One of the questions I'm seeing here is, can we implement an existing indicator based on literature? Yes, absolutely. And it's due on March 28th. Yes, that's correct. Next week is spring break. I'm cutting you all some slack for spring break. Okay, now I'm going to give you a short presentation about some real strategies that we've developed at my company. I'm not trying to sell you anything, but I thought some of you all might be interested to see examples of some real strategies that we can create using the tools that I've been teaching you in this class. So let me fire up PowerPoint here. I need to show my screen here. Okay, so I'm going to keep it just with the I'm not going to go full screen with PowerPoint here. Just not sure exactly how Google Hangouts is going to treat that, so I'm going to keep it like it is here. Okay, this is actually a presentation I gave to some potential clients earlier this week. So I'm going to pretend you all are potential clients, and I'll just show you some of the stuff we've created, and I'll watch for questions as I'm going along there. you all know about me. I'm going to skip sort of the PR about our company, and well, I'll tell you a little, give you a little bit of PR. My company, Lucena, we don't manage money directly. We're a software company, and what we do is we provide decision support to wealth managers. We have partners who are wealth managers. They use our software and/or our strategies to manage the funds of their clients. Now we take in lots and lots of different sorts of data. So you all, for instance, now are working with technical data. We also, at our company, we have fundamental data. We have proprietary data feeds like information about insider transactions. We track news and news sentiment and social media. Each day we capture 500 data points across 15,000 stocks worldwide. So each day we're collecting millions of data points for all of these assets around the world, and we number crunch them overnight and typically come up with trades for the next morning. The code that supports this is includes hundreds of thousands of lines of code. We rely on the same libraries that we're using in this class, NumPy and Pandas and SciPy. We're doing some, we utilize scikit-learn in case you're interested in that. And we've got a great quant developer team that's created from people just like you who have taken this class. So here is our process for creating a strategy. So every strategy starts with an idea. It's got to have a story that makes sense. We don't just unleash raw machine learning and hope that it works. We develop a strategy that has a story, like I said, that makes sense, and then we test it. So we implement it in code and we backtest it. If it works well in backtesting, then it's eligible for us to paper trade it forward or forward test. One thing to mention about backtesting is don't think of backtesting as something that validates a strategy. Think of backtesting as a way to invalidate ideas. There are many, many strategies that work great in backtesting but fail in live trading. But the converse is not true. If it doesn't work in backtesting, it is certainly not going to work in real trading. So what backtesting enables us to do is try lots and lots of potential strategies and rule out the ones that aren't going to work. Once we see it work in backtesting, though, okay, we'll bring it forward into paper trading. What that means is that we run the algorithm, we let it tell us what it wants to do. We simulate those trades. In other words, we look at the live market and we enter the prices of the stocks at the time it wanted to trade them, hold that portfolio, essentially obey what the algorithm is saying. And in this way, we guarantee that the algorithm has no way of peeking into the future. If it continues to work while we're paper trading in this forward testing mode, then we'll apply real money to the algorithm. Now, while the algorithm is going forward, when we're trading it live, we're always monitoring it. We're looking for poor performance or for things that we hang our hat on as being true for the algorithm to work. And if those begin to fail or degrade, we may halt the strategy. When it behaves differently than we expect, we look at what's going on and we try to improve that. I'll tell you a little bit about an example of that in a minute. Okay, I'm going to tell you about two strategies that we've developed at Lucena. One of them is named Black Dog. The other is Tiebreaker. Black Dog is a risk parity approach. I'll tell you about risk parity in just a moment. But at a high level, or giving a little bit of history of risk parity, is the largest hedge fund in the world, Bridgewater, their flagship fund called the All-Weather Fund uses risk parity. And the idea was, I don't know if it was originally created by Ray Dalio, but he popularized it with his hedge fund. And I'll explain a little bit more depth about that in a moment. But it holds stocks, bonds, real estate. The all-weather fund also holds commodities. It's long only, and the allocation to all these assets is determined systematically. Tiebreaker is centered more on the sorts of things that we're about to look at with machine learning. It's a machine learning based strategy. It's stocks only. It's long short, and we determine the positions using predictive models. I'm going to pause for a moment and see if we got some questions, and then I'll continue on with the presentation. Okay, we got a question from when I was talking about the project. Any suggestions on papers we could read for good ideas on popular algorithms? I would look at stockcharts.com. They cover all of the most used indicators. They describe how they're calculated and so on. Do you perform optimization? Let me click on that. So yes, especially with regard to the tiebreaker strategy that I'm going to show you in a moment. Black Dog uses a kind of optimization that I'll describe in a moment. It's not the mean variance optimization that you all have been using already. It's kind of a variation on that. Tiebreaker does explicitly use mean variance optimization, and I'll describe how we do that in a moment. Since Lucena doesn't manage wealth, do you get commissions such as management fees? So we have agreements with our partners who use the strategies, and we basically take a percentage of the fees that they charge. I can't go into more detail than that because it's confidential arrangements between us and our partners. But I can say that currently our fees are much lower than typical hedge funds, and that's one of the reasons it's very attractive, because people can get essentially hedge fund type performance and hedge fund type strategies without paying such high fees. Okay, we've got a slew of questions going on here. With what we've read so far on the efficient markets hypothesis, most of the ways to beat efficient markets hypothesis rely on access or asymmetric information only available to the big guys. Okay, that's a statement, not a question, but I suppose you're asking how is it that we can have strategies that outperform the market if the efficient markets hypothesis is true? Well, I would assert that the efficient markets hypothesis is not true in every case. And because the markets are not perfectly efficient, we are able actually, in some cases, to do better than the market. What can we as individual traders do? I think you're asking, is it feasible, for you as a person by yourself trying to figure out trading strategies, can you do as well as these approaches I'm about to show you? Frankly, no. And here's why: is because and don't get mad at me like, why am I teaching this class if you're not able to do that? Well, I'll explain in a minute. But it's taken us at our company 5 years to find a handful of strategies that work well. It just takes a lot of effort and a lot of research, a lot of testing, a number of developers working together. It's just not trivial. You also have to have the information feeds and so on. You can, as an individual trader, still probably do decently if you do nothing more than optimize your portfolio. I've always seen that any strategy, if you take it as it is, but you just optimize the holdings, it does better. I've seen that over and over and over again. So that's certainly a recommendation. In terms of having a trading edge over, quote, the big guys, yeah, machine learning can do it, but trading just on, say, technical indicators probably is not sufficient. You need to have a combination of multiple types of indicators, and you need to have additionally algorithms that find which factors work and which factors work together. So what I'm going to teach you in this class is, given a set of indicators, how can you build a trading strategy around it? But there's a separate sort of meta problem of discovering which factors are effective. And we just can't cover everything in this class, but the name of that problem is feature selection, and you can do some research on your own to see how you might do that. Okay, let me get to the next question here. Can you comment on what percentage of strategies that pass the backtest phase will eventually fail the paper trade? Good question. I've seen strategies fail. Let's see. There's one strategy in particular that I remember that worked in backtesting. It worked in paper trading, but failed in live trading. And the reason was that we were correctly predicting which way the stocks would move, but when we acted on that information and actually traded, we impacted the market enough that it took the performance, away. So the backtest worked great. We started trading it. Suddenly performance was flat. We stopped trading it, and suddenly performance was great. And the reason was we were trading illiquid stocks that were traded thinly, and when we acted on them, we impacted the market so significantly that there wasn't any juice left. Anyways, I didn't answer your question exactly. Let me try that again. I would say about 20% of the strategies that work in backtesting then work in forward testing. And of those that pass forward testing, most of them then work in live trading. An issue here to comment on is they may work for a little while. Eventually, they stop working. I haven't yet seen a strategy that just works forever. Maybe risk parity is a kind of strategy that can work for a very long time. But so far, machine learning-based strategies eventually kind of performance tapers. What alpha is considered good for these successful strategies? Well, that's a good question. Let me look real quick at the alpha for a couple of our strategies and give you an answer on that. Give me just one moment. Now, one thing I want to comment on here regarding alpha is the alpha I'm talking about is alpha of daily returns. Okay, so it may be a smaller number than you may have seen in other situations. Where is alpha? There we go. So for tiebreaker, well, the alpha that I'm seeing here in this report is 0.29, and that's I think that's in percent. So, but that sounds too high. So I don't think this report is correct. So let me get back to you on that answer. Another way to answer your question, though, that's probably a little bit more relevant, is information ratio. So if you remember definition of information ratio, that's essentially you take the daily return of your fund and you subtract the daily returns of your benchmark, and then you take the Sharpe ratio of what's left. And in our case, the tiebreaker information ratio, I'm going to show you tiebreaker in a moment, has an information ratio of 0.43. And tiebreaker is a strong strategy, and so an information ratio, above the S&P 500 of 0.43, then I would say is good. It's got a Sharpe ratio of actual trading Sharpe ratio of 1.88, which is also very strong. This question about breadth of stocks, I'll answer later as I get into details about the particular strategies. Okay, let me step forward here. Let me tell you now about Black Dog, and in particular, or more generally, risk parity. So the classic portfolio, if you go to a wealth manager today, the wealth manager will probably recommend a portfolio like this. They'll put you some percentage in stocks, some percentage in bonds. The classic ratio there is 60-40, and because of that, they call this the 60-40 portfolio. And as you're probably aware, if you're many years from retirement, they'll recommend a higher stock proportion. If you're getting close to retirement, that proportion in stocks will decrease, and you'll be more in bonds. This is the sort of the most basic form of diversification, and reason diversification is important, and the reason it works is that what diversification really means is that you have assets that are either uncorrelated or maybe anti-correlated, and the more your individual assets are uncorrelated, the better. And the reason for that is it means that if something, some negative news hits one of your assets, because it's uncorrelated with the others, you're not going to be hit across the board. And stocks and bonds are two classically anti-correlated asset classes. A problem with this sort of portfolio is if you look at risk. Let me go back there. If you look at risk, and as we talk about in this class, if we measure risk as volatility, you can see that stocks are clearly more volatile than bonds. And if furthermore you've got most of your funds in stocks, you've got essentially 6 times the risk in terms of funds at risk in stocks. And a problem with that is when we're in a market regime, say when stocks aren't doing well and bonds are doing well, you're not making much now on your bonds, and you're potentially losing a lot on your stocks. So the key idea here of risk parity is to consider multiple asset classes and to try to equalize the risk in each asset class. So here's some reasoning behind that. Each of these asset classes performs well in different market regimes. And what Ray Dalio asserted was, we don't know what market regime we're going to be in next month. So let's not try and predict that. Let's just be prepared for that upcoming market regime by holding several different kinds of assets. And furthermore, let's seek to equalize the risk across these different assets. So, for instance, I mentioned earlier that bonds typically are lower volatility. Well, a typical risk parity portfolio will have a fair amount of their assets in bonds because they're not volatile, not very volatile, and so you can afford to put more assets there. And one other thing to mention is, once you put all these assets together and weight them according to volatility, typically the overall portfolio has lower volatility than the market overall, but also typically slightly less return. So what you often do is you add leverage. So you lever up the whole portfolio so that you've got about the same return as the market. About the same volatility as the market, but higher return. So this is how that strategy has worked since 1996. Since that time period, nearly 300% cumulative return. You don't see it versus the S&P 500 here, but it's got much lower volatility. This is performance of the all-weather fund, of Ray Dalio's all-weather fund, and it's churning out on average 6.3% per year. Last year, they had a bad year. All of the risk parity funds, well, I should say all of the professional risk parity hedge funds had a bad year last year. The all-weather fund lost 7%. AQR's risk parity, I think, lost 8%. A reason for that was they were very heavily in commodities. And if you recall what's happened to oil over the last year, it's been hit hard. And in fact, the all-weather fund was very heavily in oil. If you recall that in the beginning of 2015, oil went down significantly, so they loaded up on oil, but then it kept going down. So that's the reason they got hit so hard. Okay, this is a screenshot, by the way, of our software product called QuantDesk. I've shown some examples of its use in the class lectures. I'm going to skip details on that right now. Here is the performance of Black Dog. We've been trading it for almost 2 years now. Orange is performance of the strategy. Green here is S&P 500 over that same time period. And blue is AQR's risk parity strategy. So as you can see, we've outperformed all three. As you can also see, though, 2015, it's hard to see here, but we were positive in 2015, but just barely. We outperformed competing risk parity funds. We very slightly underperformed S&P 500 overall. On the other hand, our volatility was lower than the S&P 500, so at least that was good. But anyways, over this time period, we've seen a return of 25%, and max drawdown of 14% compared to 17% for the market, and a strong information ratio there of 1.0. Anyways, we were not happy about, even though we outperformed other risk parity strategies in 2015, we were not happy about being flat, essentially. So we looked at ways that we could make this strategy even better. And one of the things that we're constantly doing is we're always running algorithms to consider what assets we ought to consider for use in Black Dog. And I don't know if I mentioned what assets we do use, but I'll mention that now. We trade ETFs only that represent huge asset classes. So we use large cap equity ETFs. We use long and short term U.S. Treasuries. We also use ETFs that represent real estate that are called REITs. We do not use commodity ETFs. The reason is, well, so first I should say commodity ETFs are a big part of Ray Dalio's strategy, but every time we add them to our portfolio and backtest them, it doesn't work well. And because last year we were not in commodities, that's why we didn't get hit 7 or 8% like the all-weather fund. So for now, we're probably going to continue not including commodities, but we're always checking to see if it makes sense to add them. Anyways, the way Black Dog works is each month we run our risk parity algorithm, which across these asset classes seeks to equalize the risk across them, and it determines these allocations based on that monthly risk parity calculation. And it works because it's exploiting essentially this structural relationship between stocks, bonds, and real estate. When we backtested across 13 years, every single year for the last 13 years, we've seen positive return. Okay, but like I said, we weren't happy with 2015, so what did we do? We went back to our process here, which is constantly monitoring what's going on, and in particular, we looked for new assets that we could add that would help us in 2015, and also actually helped us outperform in backtesting. And once we hit upon this new asset class, we paper traded it forward, like I mentioned, and we saw it was working well, and so we've shifted now our portfolio to include this new asset class. What is that asset class? Um, I'll give you all a hint. I'll come back and answer that later, but let me give you a hint, and we'll see if anybody gets it. It's an asset class that is kind of a blend of stocks and bonds. And because it's somewhere between equity and bonds, it has performance that's not quite correlated with either one, and gives us another uncorrelated asset class. I'll get back to that. I'll come back to that later. Let me check and see if folks have any questions. No questions. Okay. All right. Next strategy. So I talked about Black Dog and mentioned some of its weaknesses. Well, I didn't mention all of them, but let me hit on one. Sometimes stocks and bonds are correlated, and they go down together. So, for instance, in August, let me go back and show you our performance chart here. August 2015, Black Monday, everything went down. Stocks and bonds, and stock market was hit, and risk parity strategies were hit. Because we're long only, we're subject to those sorts of things. So what if we consider a long short strategy, and instead of rebalancing monthly, what if we rebalance or trade more frequently? Now, before I launch into that, I want to talk about long-short trading. And by the way, think about, I mentioned this is a presentation I gave to potential investors, and they're not all as sophisticated as you all are. And most people are really nervous about shorting. And our strategy Tiebreaker indeed shorts. And so part of what I wanted to do there is show people why they didn't need to be so worried about shorting. In fact, done right, shorting can reduce volatility and reduce risk in a portfolio. On the other hand, a purely short strategy can actually be risky and dangerous. But let me show you a couple examples of how shorting can provide an advantage. Roll back time to June 2015. And let's assume we have some information or some insight that leads us to believe that Delta Airlines is going to outperform other airlines. Now, notice I didn't say Delta Airlines is going to go up. What I said was we believe it will outperform other airlines. So if all airlines go down, we think Delta will go down a little bit less. Or if all airlines go up, we think Delta will go up a little bit more. Now, what if we go long Delta and short American Airlines? So like I said, we think Delta is going to do better than the other airlines. We don't have any specific information about American Airlines, except that we think Delta is going to do better than other airlines in general. Now, by longing one airline and shorting another, we are, to a large extent, removing the airline risk from the equation. Because if all airlines go down, both of our stocks are going to go down, but we'll make money from having shorted American. We'll lose money from being long Delta, but that'll equalize out. So whatever particular risk there is to airlines, we're kind of canceling that out of the equation. And all that we're left with is the specific information we've got about Delta. So let's look at that example. Here we're rolling back to June 2015. The blue line is Delta. The red line is American Airlines. And as you can see, over the subsequent year there, Delta indeed outperformed American by about 15% there. But notice they followed a pretty similar trajectory. You know, when there was a bump in airlines, both of them bumped up. When there was a drop, they both dropped. And they, just for example here, I include S&P 500 here in yellow. They moved similarly to S&P 500, but not always the same. So for instance, this volatility in here was unique to the airlines, but not present in S&P 500. Now down here, I show a backtest of us going long Delta, which let's see, let me make that, let me zoom in here and make sure I'm, just a second. Just want to make sure I've got my, yeah, okay. I believe what we're seeing here is that this green is Delta, the blue is the market, and the orange there is American Airline. I'm sorry, is the overall portfolio. You're not seeing the short of American Airlines here. Things to note here is that this overall strategy is very smooth. It's positive. We essentially harvest the difference between these two stocks over that year. Note this big, huge drop back in August didn't phase the strategy at all because we were long short and essentially immune to that. So here over this period, we like I said, we harvested that difference and had a nice smooth trajectory. Now, what it requires to succeed, of course, is that you know which stock is going to do better than the others. Now, you might say, okay, that's easy. They both went up. What about a situation where both stocks go down? Well, here's another example of some energy stocks. We're looking at Exxon and COG. And let's suppose, again, we had some information that Exxon was going to do better than COG. But note, they both went down over this time period. Still, this long-short strategy, going long Exxon and short COG, provides this spectacular performance here in orange. Did even better than the airline example. So with long-short strategies, we can make money if our asset class goes down or up. So that's the story on long-short. Let me talk now about hedging. So I'm telling you about all these underlying technologies because they're all part of this tiebreaker strategy. In fact, let me, before I get deep into hedging, let me give you an overview of tiebreaker. What we do with tiebreaker is that we identify 5 to 10 long positions, stocks that we think are going to outperform the market over the period of a week, just 1 week. We use machine learning approaches to forecast the future prices of all the stocks in the Russell 1000. We identify, like I said, a handful, 5 to 10, that we think are going to do best. Then we optimize that portfolio of 10. We use our mean variance optimizer. We optimize for max Sharpe ratio. Then we build a hedge. So half of our portfolio is in these long positions. The other half is in a hedge. And I'm going to show you now how we build that hedge. First thing I need to tell you about is this underlying technology, algorithm is a better term, that we call portfolio replication. So here is the problem that we present to our portfolio replicator. We give it a historical time series, historical prices over time, and then we ask it, it doesn't know what's in that portfolio. We ask it then, okay, figure out what's in that portfolio and what the allocations are. So as an example, we conducted an experiment where we gave it the historical, actually here you can see it in red, we gave it the historical price performance of the Dow. Now, our algorithm didn't know what stocks were in the Dow, but we said, figure it out. And so the algorithm searches across all of the S&P 500. It found 30 stocks. 28 of them exactly were members of the Dow. It got 2 of them wrong. As one example, it selected Chevron instead of Exxon. And this is an algorithm that, sorry, I can't tell you the details of. It's proprietary to Lucena, but you can imagine that it uses some sort of pattern matching, and indeed it does. Now, that's portfolio replication. Let me show you now, if you have an algorithm that can do that, let me show you how you can turn that into a hedger. So let's suppose this blue line represents the historical performance of a core set of assets that you want to hedge. Now, what does the shape of the curve that is the perfect hedge look like? Well, imagine what essentially the perfect performance would look like. It's this diagonal red line. In other words, if we could hedge out all of the volatility, but still maintain the return of our core, what we would get is this smooth diagonal red line. Okay, if half of our portfolio is in this blue portfolio, in this, providing us this blue curve, what is the shape of the curve for the ideal hedge? Well, we find that just by essentially mirroring the blue line about this red line. That gives us this green line. And the shape of that green line then is the perfect hedge for our core portfolio. And we ask our portfolio replication algorithm, okay, go find out what's in that green portfolio. And that then is our hedge. Now, one thing to mention is it doesn't necessarily have to be all short positions. It can be long and short. Now, let me show you the performance of the resulting strategy. So again here, orange is the performance of Tiebreaker. Blue here is the S&P 500. And we've been trading it for about a year and a half. Actually now we're, it says 24%. Actually, we're up to 30% return now over that year and a half. Sharp ratio is, over that period, is 2.3. So it's really been awesome over the last year and a half. And just and this is live traded results. So this isn't even paper trading. This is real money trading this. In backtests, back over 5 years, every single year, positive return. So we're really proud of this one. Let me recap real quickly how we do it. We scan across Russell 1000, S&P 500. We forecast the 1 week returns for all these stocks, and we settle on what we think are the 10 best. We then optimize that long portfolio. Then we use the we use the hedger to find another 10 positions. That is our hedge. We enter all those positions Tuesday morning. We hold them until the following Monday market close. So we hold for a week. We exit everything Monday at market close, and then enter the new positions Tuesday morning. I should add additionally that we set stop loss and stop gains on all the positions. So if they reach our price target, we go ahead and exit, or if they're losing, we exit also. So we're not necessarily holding everything for that full week. Okay, so that is two real strategies. People have been asking to learn about real-world strategies, and those are two that we've developed in Python using Pandas, NumPy, and so on. Same tools that you guys are using, strategies that we've created at Lucena. Let me now see if there's any questions. Okay, so somebody a while back I threw out the question, hey, what do you think this new asset class is in Black Dog? And somebody made a guess here. Convertible bonds. Great guess. Great guess. In fact, no, we're not using convertible bonds, but we're looking at adding that as an asset class. The answer is we're using preferred stocks, preferred shares. Okay, next question. What was the purpose of performing a reverse lookup for finding the stocks? Let me put that forward. What was the purpose of performing a reverse lookup for finding the stocks? I don't fully get your question, so maybe you can rephrase it, and I'll understand better what you're asking there. Unfortunately, it takes a little bit of time for you to hear me answering, so I'll go on to another question and come back. About how many stocks might Tiebreaker hold at once? Let's see. How many stocks might it hold at once? What's a guesstimate of the minimum amount to trade such a strategy? So Tiebreaker, the core is 10 stocks, and the hedge is 10 stocks. So each Tuesday, we enter 20 positions. One thing I should mention is the hedge is not always short. Sometimes it's long. Sometimes it's a mix of long and short. Back in this time period, we were actually, the hedge was entirely long. So we were capturing, in a bull market here, positive returns because both our hedge and our core component were long. Recently, over the last several months, beginning about here in August, the hedge component of Tiebreaker has been entirely short. But it's dynamic. If we start to hit a bull market again, we might have some long positions there as well. Okay. I don't have any questions in the queue there, so I don't have a question to answer, but I'm expecting maybe another question will come along. Let me also open the floor to other sorts of questions. Any questions about the project that's due Monday? Any follow-up questions about the midterm? Just let me open the floor and answer anything you might have. You said that you find the composition of the Russell by looking at the S&P stocks. Okay, yeah, okay, I think I know what you're asking. So earlier I spoke about portfolio replication. Let me actually show you what that an example of that. This is our QuantDesk platform. So let me restate your question and then reformulate it into what I think maybe you're really asking. As an experiment, we gave our portfolio replication algorithm the following task. We gave it the historical prices of the Dow, and then we asked it from that historical time series to find the components of the Dow. So your question is, what is the purpose of this? The purpose is to see, we know the answer. We know what's in the Dow. The purpose is to see how good the algorithm is. If it gets the members of the Dow exactly right, then we know the algorithm is working well. If it misses them, then we know it's not doing a good job. So it's just a test to see how good the algorithm is. And indeed, it does really well at finding the components of the Dow. Now that we have this algorithm that can essentially reverse engineer a portfolio, we can use it in a number of different ways. Let me give you some examples. Let's suppose we have the time series performance of a hedge fund, fantastically performing hedge fund. If we knew its daily net asset value, we could use this algorithm to find out what stocks are in that hedge fund. We could apply this to mutual funds as well. Or we can use it to build a hedge in the way that I showed you. The way we use it to find a hedge is by taking our core portfolio performance here and hypothesizing about what's the shape of the curve that would be the perfect hedge, and then we ask the portfolio replication engine to find the components of that portfolio, and that's how we build that hedge. Next question is, there is no final exam, right? I'm not going to answer that question. Any other questions? Okay, I'll wait about 30 seconds, and if we don't see any other questions, I'll go ahead and close. I hope you all benefited from this lecture tonight, and I look forward to hearing from you on Piazza. I'm going to wait about another 10 seconds before I close out here. Oh, okay, we got a couple more questions. Good. Are there other ratios? Let's go ahead and select that. Are there other ratios that you're using other than Sharpe or information ratio? Yeah, a really good metric is Sortino Ratio. What Sortino Ratio is it's essentially, well, okay, so let's think about Sharpe ratio for a minute. Suppose you've got a portfolio that is volatile, but it only goes up. So it's volatile up. That's fantastic, right? But to some extent, Sharpe ratio will penalize you for that volatility, even if your strategy only goes up. So what Sortino ratio does is it only, in terms of calculating the standard deviation or the volatility part, it only counts the downward movement as contributing to the volatility. So if every time you increase return by going up, it doesn't count that. So a strongly performing strategy that is volatile but only up will have a higher Sortino ratio than a strategy that goes up and down with the same return. So we just have 1 week for MC2-P2. Well, sort of. It's 3 weeks from now, so you can get going on it. It's the way it's defined online is very close to the way it's going to be described, or the final definition of it. So it wouldn't hurt you at all to get started on it. Wouldn't scanning the whole stock market eventually give the answer to that question? Okay, I think you're asking about portfolio replication again. So let me try and state what I think you're asking. I think you're asking, what if if we're trying to find, say, the components of the Dow? What if we just try all combinations of 30 stocks? Yes, you can do that, and but if you think about it, that's a really expensive process. So in particular, if you were considering a universe to be all of the S&P 500, you've got 500 choices for the first stock, 499 for the second stock, and so on. Essentially, it works out to be, I guess, 500 factorial divided by 470 factorial. Anyways, bottom line, it's a huge number. It's a huge combinatoric problem, and essentially, there's not enough time left in the universe to test all of those potential portfolios. So you need to go about it in a smarter way to find the components in the Dow. For project MC2-P2, can we use an ETF like XLK to determine significant move of IBM compared to tech ETF? That's a good question. Let me say that you can use any of the data that's provided in the that's provided in the data that we gave you. I'm not sure if XLT is in that data, but you could easily essentially build your own collection of tech stocks. You could essentially manually kind of build an ETF from that existing data. The reason I'm constraining you only to using that data is I essentially want everybody to be on an equal playing field. I respect your idea for going out and getting some different data. I think that's great, but I want everybody to be on an equal footing for this project. Okay, it looks like we've run out of questions. We've been going for about an hour and a half, which is longer than I expected. So let me close now. I hope everybody's doing well, and I will see you on Piazza. So have a good evening. Bye-bye.